We've got Jeff Lewis, who's head of investment services at JPMorgan Asset Management, who joins us on the show from Hong Kong. Jeff, to begin with, the RBI cut rates for the first time in over 3 years on Tuesday. Would it be enough, to your mind, in order to revive India's sagging economic growth?
Well, I think it is a signal. There have been very few instances where the RBI has reversed a change of direction in rates. So this is a turning point. But I think the RBI will be relatively cautious. Inflation is still at a relatively high level. The whole inflation problem has proven more stubborn and more ingrained. And the recent budget was relatively disappointing. There was not enough done, probably, in terms of fiscal consolidation to persuade the RBI to ease monetary policy aggressively at this point. So it's a sign, I think, which investors will take positively, but it's not really going to cause an early or rapid reversal in the slowdown in GDP growth, industrial production, etc.
Sure. Jeff, we'll just come back to you in a minute. Let's pull up the stock price of Hindustan Copper. There is some news coming in from government sources indicating that the government has mooted for divestment of 9.5% in Hindustan Copper. They have already moved the cabinet note for divestment in the company, and they are proposing two routes for the same, which is either via placement program or via the FPO route. They have appointed SBI Cap, UBS, Enam, iSecurities, as well as Kotak Securities as the bankers for the same. And you can see that Hindustan Copper is seeing a big reaction on the back of that news. A knee-jerk reaction higher by close to 1% and firmly in the green after laying low for most part of the day. Just recently also you did have that cabinet note which had surfaced regarding the divestment in Oil India as well as Hindustan Copper, and that's the latest that we are getting on the same, that has mooted for 9.5% divestment in the company. 2% higher now for a Hindustan Copper. We'll keep you updated with the details as and when they come in. But take it back to our conversation with Jeff. Jeff, given that, growth has been slowing down, what are the sectors in India that draw your attention and where do you see value?
Well, currently we are not actually making large sector bets aggressively, although we are overweight the private banks, we are overweight materials, we are overweight telecoms, we are overweight consumer discretionary space. But what we have seen in the market correction, we've seen wide valuation divergences within sectors, between stocks in particular sectors. So our Indian investment strategy is far more focused on a bottom-up stock picking approach at the moment, rather than making big aggressive sector bets. We think that the slowdown in the Indian economy is pretty much fully priced in, but there's still this government paralysis. We've seen capex has come down. There's not much sign of it rebounding. So there doesn't seem to be an awful lot of good macro news in the immediate horizon. Still positive, of course, on the longer-term India story. So this is a time, I think, for being bottom-up in your approach to the Indian equity market.
And Jeff, also, where do you see Indian equities over the next maybe 6 to 12 months? Do you believe that funds may start reducing their India exposure?
I think the biggest risk to India, again, would be global risk appetite and fears of a global recession. So if you rule out, say, the euro crisis taking another turn for the worse and that kind of plunge in global risk appetite, I don't think, unless you get that kind of extreme scenario, that we're going to see a major reversal of funds out of India. What has impressed us has been that a lot of the institutional foreign investor money coming into the Indian equity market has proved relatively sticky. So I think a lot of investors have bought into the long-term India secular growth story. And although we're going through a rather disappointing patch in terms of the macroeconomic performance, we are now at least into the phase of monetary easing. of lower interest rates. And I think from that point of view, India's 12-month economic outlook is still pretty much okay.
Finally, Jeff, what's your view on the US dollar as a safe haven?
Well, I think a lot of investors have been surprised how quickly the problems returned. We had the ECB introducing the second LTRO. We saw the very large expansion in its balance sheet up to over 30% of GDP. And that obviously relieved the funding problems of the banks for a while. And we saw sovereign yields coming back in the periphery. Now, of course, it looks like investors are doubting whether austerity actually is sustainable in economies like Spain or Portugal. And the other side of the coin, of course, is that the euro crisis is very much an external balance of payments crisis as much as it is a sovereign debt crisis. And some of those economies, unfortunately, still have large current account deficits. It needs the ECB to, I think, continually replenish the LTRO, because at the moment it's the only source of capital inflow for economies like Portugal and Greece. And yet, with perhaps now the first signs of inflation appearing in Germany, there could be dissent now that over the direction in which ECB monetary policy is taken. There could be more resistance, perhaps, from the Germans to further monetary easing. So I think it's a long, long road, and we're still, at best, a quarter of the way through. So we're going to continue to see problems in the Eurozone coming to a boil, and we're going to have to see further monetary easing from the ECB, whether it likes it or not.